Good day everyone, my name is Mak Kar Wing, Matric number 305483. And now I will present my individual assignment for credit risk management. My research topic is the determinants of credit risk of US Bancorp. First, let me briefly introduce the background of this study. The United States has the largest economy in the world and a strong advanced financial system. Its banking sector plays an important role in supporting global trade, investment, and also economic growth. The US banking industry is highly regulated by the Federal Reserve and the FDIC to ensure financial stability. However, credit risk remains one of the biggest challenges because borrowers may fail to repay their loans. For this study, I selected US Bancorp, one of the largest commercial banks in the United States. It was chosen because of its stable financial performance and the availability of financial data from 2015 to 2024. Next is the problem statement. Credit risk is an important issue because it directly affects a bank's financial performance and the stability of the economy. If a bank has poor credit risk management, loan default may increase and create a systemic risk, also known as the domino effect, where problems spread to other banks and the financial system. History has shown us the serious consequences of weak risk management, such as the Great Depression and the 2008 global financial crisis. This study has three research objectives. The first objective is to determine the impact of bank-specific factors on credit risk. The second is to determine the impact of macroeconomic factors on credit risk. And the third is to examine how both internal and external factors together affect the credit risk of US Bancorp. Based on this objective, three corresponding research questions were developed to investigate this relationship. Now let's move to the literature review. According to Lucis, Moody's, and Metasas, credit risk is commonly measured using the non-performing loan, which is calculated by dividing non-performing loan by total loans. The ratio is widely used because it shows the quality of bank loan portfolio. For the internal factor, I follow the framework of Ben Nausio and Omran. In this study, I selected variables such as return on asset ROA, liquidity risk, and management efficiency to examine how a bank's internal performance affects the credit risk. For the external factor, I selected microeconomic variables including GDP growth, inflation, and interest rate, as this economic condition can influence borrowers' ability to repay their loans and therefore affect the credit risk. Let me explain the methodology. This study used 10 years of data from 2015 to 2024, collected from the annual report of US Bancorp and microeconomic data sources. To process this data, I use SPSS version 30. I apply multiple linear regression using the ordinary least square method to examine the relationship between the variables. Two regression models were developed. Model 1 examine the impact of internal factor on credit risk. Model 2 examine the impact of external factor on credit risk. And Model 3 examine the combined impact of both internal and external factor on credit risk. This comprehensive analysis ensures that we capture the full story behind credit risk. Now let's look at the descriptive statistic. Overall, the results show that US Bancorp maintained a relatively stable financial position during the study period. Among the bank-specific variables, loan loss provision recorded the highest volatility, meaning that bank adjusted its provision for bad loan quite frequently. The bank also had high leverage, but its capital adequacy ratio remained above 13%, showing that it still maintained sufficient regulatory capital. For the microeconomic variables, GDP growth, inflation, interest rate, and unemployment rate remained relatively stable, indicating that a general stable economic environment during the study period. Next is the Pearson correlation analysis. The results show both positive and negative relationship with credit risk. For example, money supply M2 has a positive relationship, meaning that as M2 increase, credit risk also tends to increase. On the other hand, exchange rate and RA have negative relationship, suggesting that improvement in these variables are associated with lower credit risk. However, correlation only shows the strength of the relationship. It does not confirm whether the variables are significant. To determine significance, I conducted the p-value test. The results show that 6 variables have a significant relationship with credit risk. Among them, exchange rate, loan size, money supply, and RA are significant at the 5% level, while yield curve and loan loss provision are significant at 10% level. This means these variables are statistically related to credit risk and are less likely to occur by chance. Next is the modal summary. The adjusted R-square tells us how much of the variation in credit risk can be explained by each model. Model 1 explains about 62% of the variation. Model 2 explains about 85%, which is the highest. Model 3 explains about 80%. This indicates that the external factor model provides the strongest explanatory power for credit risk. The ANOVA test determines whether each regression model is statistically reliable. The results show that only model 2 is significant with the p-value of 0.047, which is below 0.05. Meanwhile, model 1 and model 3 are not significant. This means that the model containing only external factor is the most reliable model for explaining credit risk. Now, this is the most important part of the study. The coefficient analysis identifies which variables have a significant impact on credit risk. In model 1, RA and regulatory capital are significant. This suggests that better profitability and stronger capital can help reduce credit risk. In model 2, inflation, exchange rate, and unemployment rate are significant, showing that macroeconomic conditions have a strong influence on credit risk. Finally, in model 3, inflation and unemployment rate remain significantly even after combining all the variables. Overall, this finding indicates that external factors play a greater role in determining the credit risk of US Bancorp than the internal factor. To conclude, this study found that external factors have a stronger impact on credit risk than internal factors. Among all the variables, inflation, exchange rate, and unemployment rate are the most important determinants of credit risk. Based on this finding, I recommend 3 strategies. First, banks should integrate real-time macroeconomic data into their credit risk model to better predict future default. Second, they should maintain strong capital and sufficient liquidity to improve resilience during economic downturns. Finally, banks should focus on improving profitability through high-quality lending, as a stronger RA helps reduce credit risk. Thank you so much for listening.